Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and this is Trading Places Live. It's Tuesday, September 28th, 2021, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we do have futures down pretty significantly, especially on the NASDAQ. Dow Jones futures down about 0.5% or roughly 180 points. The S&P 500 futures down almost 1%. Down about 42.5 points, and NASDAQ futures down 1.7% or 260 points. So clearly seeing some weakness in U.S. equities ahead of the open. Oil prices continue to move higher. We're seeing crude oil over $76 a barrel, which is up about 1%. And the 10-year Treasury yield at last check was up about 5 basis points to 1.53%. So I think part of the problem here with the tech stocks is anytime you get yields moving higher, valuations on tech stocks are going to go a little bit lower just because you're going to use those interest rates to discount future earnings. And so as rates rise, that actually eats into some of those future earnings. So any company that grows fast is going to suffer a bit when the rates go up. But if the rates are going up because the economy is going to strengthen, then the economic growth that we see should offset those interest rates until you get to a point where the rates get too high. I don't think we're anywhere near that point. So I believe some of these really strong tech stocks that are getting swept up in some of this selling, to me, it probably makes some sense to take a look at. But anyway, we'll get into all that in just a minute. First, I want to take you over to EarningsBeats.com, where you can take out a free trial to the Earnings Beats Digest. Simply type in your name, email address, hit the subscribe button, and we'll make sure you get set up there. It is published 3 times a week: Mondays, Wednesdays, Fridays. No credit card required, and you can unsubscribe at any time. We'd love to have you. Just a way to learn a little bit more about Earnings Beats, the way we approach the market. I think you'll find it highly educational, and also some tradable charts and actions that you'll be able to take, I think, based on some of the work that we do. Let's go ahead and jump into that agenda for today. So we're going to go ahead and start off with the daily market recap. Then we'll jump into talking technically, sector analysis, earnings spotlight, and we'll wrap up with the 3 you must see. So let's go ahead and jump in to that daily market recap. The Dow Jones Industrial Average yesterday did finish up 71 points. The S&P was down 12. The NASDAQ down 77. So that same weakness or relative weakness that we saw yesterday in the NASDAQ with rates going up, that's carrying over today in this morning's futures. Yesterday, mid caps up 24 points, small caps up 24 points. That's 1.8%, by the way, on the small cap index. So when you get the yields moving up, it's a tendency. It shows that we're looking at potentially a better economy ahead, strengthening economy. And of course, that is going to be good for small cap stocks here in the US. So small caps tend to do well when yields are rising. And we saw that yesterday. I expect we'll see that as long as the yields continue to trend higher. Energy rose 3.5%. That was the top performer yesterday. Crude oil prices have been on the move. We're getting back close to a very key area of resistance, long-term resistance on crude oil prices around $77, $78. As I just mentioned, we're over 76. So getting really close. So I think we're going to watch probably that 55 area on the XLE, maybe 55, 56. It's going to be an area where we've seen congestion in the past. I think we'll probably see it again as we move further to the upside. Financials beginning to strengthen both on an absolute and relative basis because of these yields rising. That tends to make for a much more favorable outlook on many areas within the financials, especially banks and life insurance companies. Real estate down 1.67%, healthcare 1.42%, utilities down 1.18%. Those were your 3 laggards yesterday. And what I find interesting is even though all the talk was about technology getting hit, it was really the defensive stocks getting hit, not only on an absolute basis, but clearly on a relative basis. And if you look closely, you can see real estate down below its key moving averages. Same goes with healthcare Same goes with utilities. So while some of the other areas like consumer discretionary are starting to improve, and especially energy, we've seen that in recent days. But consumer discretionary is a big area. And as that group continues to move up and break out to new all-time highs, we're looking at defensive groups that are moving to, 1 to 3 month lows. And that to me is bullish for the market in the sense that at least when the market's pulling back or in a period of consolidation like we're in right now, we're seeing more selling in defensive areas than in aggressive areas. And if Wall Street truly believed that we had a rough period coming up, those aggressive groups, consumer discretionary, would not be breaking out to a new high. Technology, even though it's been a little rough here recently, wouldn't be outperforming the defensive groups. So I question the length of this bearish period that we're in right now, or this period of consolidation. I don't know that it'll last very long. I do think that we will see the market rebound. And I don't think it'll be long before we're breaking out to new highs again. I suspect it's going to be in October, but if not October, I do believe it will be in November. That will be in some new highs. October's got this, it's got a bad rap in terms of being a horrible month for performance. In fact, if you look back over the last 20 years or so, October's been one of the best months on the S&P 500. It trails, I think, November and April. But otherwise, it's a pretty solid month. But it gets a bad rap still because of some of the huge declines in our history that have occurred during October. You think back to Black Monday and the 1987 crash. Go back to 1929. I mean, two of our biggest sell-offs in our history occurred during, or at least began during the month of October. So, October gets that bad name, but it really, when you look at the big picture, is not that bad of a month. And it is an earnings month. It's the first month of a calendar quarter. So a lot of stocks do run up heading toward earnings. We'll see whether or not that's the case started, this year or this October. We'll see if we follow that pattern. The 10-year Treasury yield first. We've got a few economic reports out later this morning. July Case-Shiller home price index will be out. It's expected to rise 1.6%. June rose 1.8%. So it's expected to come down a little bit, but still that July number pretty strong, 1.6% gain. July FHFA house price index rose 1.5%. June was 1.6%. So another pullback from the prior month, but still a really strong number. And by the way, both of those reports coming out are July reports. I mean, we're about to go into October. That's looking in the rearview mirror. I don't pay a whole lot of attention. I think you'd be better off just following some of the home construction stocks and what the index is doing. I think that gives you better information than looking back 4 months at these reports. And then later this morning, September consumer confidence will be out. August was 113.8. September expected to rise to 114.8. Looking at the 10-year Treasury yield, we don't have anything showing up yet, but I did see at another site that the 10-year Treasury yield up 5 basis points this morning. So we're set to jump again. Once we got through 140, and that's kind of the number I was looking for and kept talking about in this show. Once we got through 140, I felt like we were going to begin an uptrend in the 10-year Treasury yield, and that's exactly what we're doing. And the reason that I show financials relative to the S&P 500 is that when you start making moves, these big moves in the 10-year Treasury yield, look at the relative performance of financials. So this is a group, as long as we remain in this uptrend, I believe financials is a group that you want to be represented, whether it's in banking stocks, life insurance stocks, maybe just the XLF, which is the sector ETF, or you can look to, some of the individual stocks within, several different industry groups. But financials do look really strong to me here right now. The shocking part is that even with the yields breaking out, we're still struggling. Industrials have started to turn up. We're down near 52-week relative lows. I mean, this is an area where industrials really need to start kicking into gear. Fourth quarter tends to be a strong one for industrials. So we'll see whether or not that prior history makes a difference. But if yields continue to move up, we should be seeing industrials turning higher. Now, throughout this whole period of decline in the treasury yields, you can see industrials relative to the S&P did not perform well, just like the financials. But as we stabilized in rates and started to turn higher, you can see financials were, did the same, but industrials have not. And so I would expect that we'll get a big move here coming up in industrials. It doesn't make sense if the yield's moving up and we're thinking that the economy is going to strengthen. Industrials should do well in that environment. So they're economically sensitive. When yields start moving up, we tend to see many of the areas within the industrials do well, especially transportation stocks. We'll see whether or not that's the case. All right, let's move on to talking technically. And here I just wanted to go over the major indices with you. So we'll start off with the S&P 500. This is a 4-month hourly chart. So, you're going to get about 6 or 7 candles for every day, 6 candles, I guess. And so we go all the way back into the latter part of May into early June. That's how we're looking at this. So the main reason I wanted to do this is it gives you a lot of detail, what's happening intraday, but it also kind of gives you a little bit more of the big picture as well. So as we moved up, we pulled back in June, set an important low, moved up into July, pulled back, set an important low, moved up into August, pulled back, set an important low, or at least one that I would have thought was an important low, 3, triple bottom right there. But with the Monday following options expiration this month, we saw that huge gap down, very big selling during the day, and then the market came right back up the rest of the week. So what was interesting about this most recent pullback is that it didn't really turn on any of our major indices. There was no turn at a major support level. I mean, when I looked at the S&P 500, and I don't recall exactly which chart I was showing, but when I was looking, I'm looking, okay, there's a key support level, support, 3 times. We went right through it on the Monday following option expiration, never even looked back. And then the next really key support level, I would say, would be that mid-July low. And look at where we turned, right in the middle. It wasn't even at a support level. So, and was the case with many of these, the major indices. We just never really saw huge support levels hold, and maybe that's because as we keep going up, these short-term support levels aren't really that big a deal. I don't know. Anyhow, it looks like we're going to start to roll back over again today with futures. So for the S&P 500, I'd be looking first at the 50-day moving average. Beyond that, if we don't hold and we're back below these moving averages, this certainly could be a period of consolidation where either we go back down and retest this low, or maybe we haven't found the low yet. Maybe we do need to go back down one more time. Maybe we need to find that July low. I'm not making that call because we do have earnings coming up in a few weeks, and I think the market will begin to turn its attention there. But I just think we have to be maybe cautious because we're not at an all-time high. That was back here at the beginning of September. And this could be the start of a period of consolidation before, in my opinion, we make a fourth quarter breakout. All right, next up, take a look at the Dow, just see if there's anything different on the Dow. Well, I think the Dow's strength here recently was a little bit better than the S&P's, because if you look back at the S&P, when we moved up, we couldn't take out that middle of September high, this triple top coming across here at about 44.85, 44.90. If you look at the Dow, these tops were all cleared on the high yesterday morning. So I think we've got maybe a little bit of bifurcation, a little bit more strength in the Dow Jones, but that's followed by relative weakness in the Dow. You can see the Dow topped back in August instead of early September. So the Dow had already started to roll over earlier. Now the Dow is starting to come back sooner. We'll see whether or not we hold the 20-day. If not, probably more consolidation and sideways action ahead. All right, let's go to, let's do it the NASDAQ. So the NASDAQ got back. This looks a little bit like the S&P, at least in the sense of just barely getting back through this gap resistance, unable to get back up to this triple top from the middle of September, and now starting to roll back over again. So the NASDAQ still looks a little weak. I think there are 3 key levels here to watch to the downside. So if I'm pulling those up, just that recent low last Monday, then we've got the August low, and then we've got this July low. I don't know if we're going to continue to move down or not, but, maybe keep an eye on, maybe a trend line here. So as long as that trend line holds there, it seems like the path of least resistance, short term anyway, is to the downside. And that's what futures are pointing to right now. All right, let's look at small caps on the same chart. Now look at small caps. Small caps have been beaten up much worse earlier over the summer, but we're seeing strength. I mean, we're almost back above the September high. We got close to it. So this strength over the last week, we've been absolutely seeing outperformance in the small caps of late. And with rates rising today, I suspect that's going to be the case again today, is that we'll see small caps outperform. Then the final one, mid caps. Mid caps kind of middle of the road. Mid caps doing better than the NASDAQ and S&P, probably about the same as the Dow. Not as strong as the small caps, but still performing pretty well here of late over the last week or so. So any weakness here, we're going to want to watch to see if the 20-hour EMA holds. But all the major indices, until we get breakouts, I would be treating this as just sideways consolidation. I'm not treating it as a long-term downtrend. I just don't see the signals for that. So I would treat this much more as a sideways rectangular kind of consolidation period. All right, let's see. The next thing I have for today. Oh, let's move into the sectors. So I want to look at 60-minute charts. Now, this is just over the last 2 months or 3 months, but let's do 3-month, 60-minute chart on the various sector ETFs. And down at the bottom on these charts, I also have the sector performance relative to the S&P. So one thing to point out with technology is, yes, we did underperform yesterday. This wasn't the worst group. As I showed earlier at the top of the show, the defensive groups were the worst performing groups. But we did see, and we have seen, a couple of, little cracks in the short-term foundation for technology, and I'll point these out. First, on an absolute basis, when we did go down last week, I mean, we had pretty good support coming across here, and we went a little bit below. And then when we rallied back up, we got through the gap resistance, but couldn't get back to these prior highs right here before starting to roll back over. The other thing I'll point out is that we've had, many relative bottoms in this range between about, 0.03485 and 0.0349. So right in this area. Yesterday, when we went down here, even though we didn't break below on an absolute basis, we did break down on a relative basis. And so that's a little bit more concerning, only because short-term rotation, we saw technology breaking out versus the S&P 500 in late August and into the first half of September. But second half of September, we've seen it actually start to break down a little bit. So this is something worth watching. We don't have I wouldn't say a major relative low until we get all the way down to here. I don't think we'll go down that far, but we could certainly trend a little bit lower. And that's what I'd be looking for here in the near term. Next up, this group I like, consumer discretionary. First of all these tops around 184, 185, we cleared it yesterday. So we finally got a breakout and a close above 185. That's an all-time closing high on consumer discretionary stocks. Not bad when you look at where the S&P 500 is, right? So what that means is look at the relative strength in consumer discretionary right now. This is an area that the market is favoring. So while money is rotating away from technology and away from some other areas, I'm going to show you here in a second, the money is rotating toward consumer discretionary. That's definitely worth paying attention to. Communication services, look at the relative chart down here on the bottom. So this is a group where we've been seeing in September a lot of money rotating out of the group. I don't think that's going to last, but it is notable that we went to a multi-month relative low. So this is an area to watch. Maybe if we can get back through gap resistance around 83, we can start to right the ship. Until then, at today's open, likely to see another move to the downside. We'll have to see whether or not 80.5 holds. If that doesn't hold, I'd go all the way back to that July low near 79. Industrial. So here's the relative strength. We're starting to see it pick up over the course of the last week. So yields have been rising over the last week. We're seeing a little bit of relative strength, not a lot. I would be looking for the relative strength to pick up. So even if the industrials go down today, I would expect that they're going to go down less than the overall market, especially with the yield rising. That should be the case. On the other hand, we could see a bottoming head and shoulder, left shoulder, neckline, head, right side of the neckline, and potentially a right shoulder. So break above 102 would be a short-term positive on the absolute chart. And we're already starting to see a little relative strength. So this is a group I definitely favor. I think that they're going to pick up. I don't know why they're not performing nearly as well as the financials, but they're not. Market, maybe it's telling us something. But for now, I still believe we're going to see transports begin to lead industrials to the upside. All right, financials. So the financials, since the yield's been going up, I mean, there's no doubt this has been your group right here, along with consumer discretionary. But I think the rate of ascent here has been much stronger on the financials. Look at the relative strength breaking out to new highs. Very, very nice action here on the financials. Consumer staples. Now, what I want you to pay attention to, if things were really going to be bad, typically when the market is, really rough, we tend to see outperformance by the defensive groups. Look at consumer staples going down. Look at the relative strength. So as consumer staples going down, their consumer counterparts, consumer discretionary, going straight up. I mean, look at consumer discretionary. So during September, it's actually, especially last week, it's broken out to new highs. It's up in the month of September. We go back to consumer staples, down in the month of September. Why in the world would you go into the aggressive part of consumer stocks if the market was going to turn down long term? Wouldn't make any sense. You would want to be in the more defensive areas. So Wall Street is putting its money into consumer discretionary stocks. That's telling me that this period of weakness, whether it lasts, one more day or another couple of weeks or even a month, it's not a long-term issue, in my opinion. I think we're already beginning to see consumer discretionary stocks running up toward earnings. I think we could be in a pre-earnings phase for that area. Anyway, consumer staple, not good. Then we got healthcare. Look at healthcare on a relative basis. We're moving down near 3-month relative low on healthcare. It's a defensive area. Look at real estate, setting a new 3-month relative low. It wasn't that long ago. Real estate, if we went back and talked or played one of the recordings, I don't know, it's probably Trading Places Live, or maybe I wrote an article, I don't recall. But real estate, I said, you got to be careful as it was making this move. You can see the negative divergence. So right when it was up here around the 48.5 area, we talked about real estate. It was leading the market. Look at the relative strength. It was getting right up here close to overhead resistance, and talked about this being an area you got to be careful with in the short term. And we've been seeing selling. Now, I think real estate will be back. I think all groups are going to go higher in a secular bull market. But on a relative basis, look at the weakness here over the last week or so. Utilities, same thing. Look at the 3-month relative low just set. Wasn't that long ago, we were up there with that triple top, 69.5, looking to break out. And now we've gone through this huge move back to the downside. So we're seeing money rotate here in September. It's not like the whole market is just breaking down. As I said earlier, consumer discretionary, a new high. Financials, new high. Industrials may be starting to turn the corner. We already know energy is doing well with crude oil prices going up. So it's just this money rotating. It's not allowing for the market overall to go lower. And that's what I think will continue. I think we'll consolidate. We'll see more rotation. And then I believe we're going to break out. All right. I'll do energy and materials quickly. I want to run through. You got materials. We're still really weak, though, on a relative basis. They've been going down for almost 2 months, getting a little bit of life here in the last week. But I don't know. Maybe we'll continue to trend up a little bit there. Energy definitely strengthening. I think we've got room to 55, 56. Or I'm going to say 55. and then we'll see what happens with energy. If the dollar moves up, then I think energy will probably find a lid at about 55 or 56. If the dollar pulls back, we could get that breakout in energy. So that is what I'd be looking for there. All right, moving on to the earnings spotlight, just a couple of stocks here. One, CNXC, this is Concentrix Corp. AD line was really good going into its report. It had been moving higher on a relative basis, though it had struggled a little bit versus software. I talked about this one during my show yesterday, and I just said I expected it would probably have a decent report. It's in a strong group, software. It's been trending higher. AD line looks good, like I said. So they reported earnings last night, 249 versus 224. Stock up 4.5% pre-market, so looking pretty good there. ACB, smaller cannabis stock. The AD line's been going down. Price action been going down. Wall Street not very interested in the stock. They did beat 21-cent loss versus 22-cent loss expected, but stock was down 2.25% when I looked. So still in this downtrend. Got to at least get through the 20-day before we can start expecting anything better there. Other stocks that reported this morning or are reporting this morning, Thor Industries was up about 4% pre-market. I didn't see the report, but apparently it reported and I guess had some good earnings as it was up a little bit. Same goes for UNFI, which is United Natural Foods. Stock up 1.66% this morning, but again, didn't see the earnings results. Later today, we've got Micron coming out after the bell, big semiconductor stock. So at least be aware of that. Let's move on to the three you must see. And I took these three right off of the most actives for the S&P 500 and just looked at some charts I thought were interesting. So the first one I want to show you is AAL. I think AAL could have put in a reversing candle at a pretty key area on its chart. So you can see the high that was set back in July after this downtrend. That was reaction high. We went back down. We put in this double top right, or excuse me, double bottom right here. So we're in this range. Notice we went up. We tried to get through 22, failed, and closed on the low. So this tells me that AAL may be in for a little bit of a pullback. Obviously, if we can get back through 22, that would be very bullish for AAL. That would be a 4-month relative, or excuse me, 4-month absolute high. Second stock I want to pull up, and actually these next two are in autos. Tesla. I love Tesla. Been a big fan for quite a while. I love what it's done recently here with this breakout. So there was a reaction high. So here was your 900 high back in January. Had a pretty big sell-off all the way down to 550. And honestly, that kind of set the tone here for where we were going to go over the course of the last, I don't know if you can see this low, this low, this low, all around 550. And then we got this high up at 900. But this intermediate high was about 770 or so. And we cleared that yesterday with increasing volume. So I think Tesla is on a roll. I look for further pre-earnings run. I wouldn't be surprised to see Tesla approach 900 before earnings. Look at the AD line. AD line very strong. So I see strength building here, and pullback's an opportunity to enter. And then the last one I have for you is Ford. Also in this group, I think Ford looks good. AD line not as strong, and we're going to run into a little resistance, I think, around 1450. But the last few days, we have been seeing some strength in Ford. Let's see if we can get that 1450 level and potentially break through. But if we don't break through, then watch the rising 20-day on any pullback. All right, that's it for me. I appreciate you tuning in. I'll be back over at Earnings Beats on Wednesday morning for your next Trading Places Live. Just go to earningsbeats.com, click on Trading Places Live anytime after 8:45 on Wednesday morning, and you can join the show. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.